Thank you for joining. I know that it's summer, and I know for some of you it's summer holiday time, and etc. etc. So I do really appreciate you joining us. That has been that really we appreciate it every week, which is good. So what has been going on? Well, it's an important week, the start of a very important week. A lot of fundamental risks. It's almost one of those weeks whereby, well, you look at what's happened in the past, but things could change in the next couple of days. So, let's just take a look. This is pound, as you can see here. We just had inflation data out of the UK, and I just sent something out about it. But to start with, I just need to pull something up quickly. Just bear with me. I forgot about our disclaimer, so I'm just going to put that up first. Just bear with me one moment. I'll go through it really, really quickly. Shouldn't take too long. Right, guys, here. Just got to go through our disclosure really, really quickly that this webinar is provided solely as a courtesy and the aid of education to our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern or investment strategy by forex.com, and the discussions of a particular market or product herein should not be construed as an offer to sell or a solicitation of an offer to buy in any of the financial markets whatsoever. This presentation has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. It will include references to actual past trading results for discussion purposes, but past results, remember, are not necessarily indicative of future results. Increasing your leverage also increases your risk, guys. Futures, options on futures, foreign exchange and other leverage products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act, and contracts for different, otherwise known as CFDs, they are not available to US residents because of regulatory reasons. Okay, let's go back to the fun stuff. Apologies for that. I forgot that. I should have had that from the start. My apologies. But anyway, let's go through, let's look at the pound first, because we just had some key data out of the pound. We had inflation, and it came in at 2.9%. So it did rise, but it wasn't as strong as expected. The market had expected a 3% increase in inflation, for June, and it only came in at 2.9. So even though it's very, very close to that 3%, 3% is a bit of a psychological level, a bit of a line in the sand here in the UK. So the fact it didn't quite get above there is significant, because it means that the new governor of the Bank of England does not need to write a letter to the Chancellor of the Exchequer. So that is good news for Mark Carney, even though I'm sure he'll be keeping the pen and the headed letter paper at the ready, because there could be upward inflation. The biggest components to inflation that put upward pressure on it were no surprise really for those of us who live in the UK, motor fuel and also clothing and footwear. That usually happens when you get kind of when you get a change of seasons. A lot of people go to the shops, new things coming out, that type of thing. Can boost inflation. And the weakest was air travel. Why would anyone need to travel when you have weather like this at home? That's the key thing there. But as you can see with the pound, it's really been quite boring. It's trading in a fairly narrow range, consolidation territory really. We've not been able to get above 152, but likewise there's been buyers coming in, certainly this morning anyway, from 150, 150.50, so 150.5 there. That was a rumoured buying interest, a rumoured corporate buying interest as well that we'd heard. And it seems to have held right now. So that seems to have been like good data, because 150.50 so far has been one of the lows. I'll just get the exact low for you there. Just bear with me. The low so far today, 150.45. So not far from there at all. So, yeah, tomorrow really is the key event. For those of you who follow our research, let me just, I'm just going to send you a link to it because I thought it was quite important. I wrote something yesterday about an important event that's coming out tomorrow, which obviously is the, Bank of England minutes. Sorry about that. I just had to pull it up. There we go. There's a much more kind of in-depth account about that on that link to our website. So hopefully you guys can check that out when you get a chance. It should work for you all, and it just gives our outlook for the minutes tomorrow and why they're significant for the markets, what their significance could be for the pound. So certainly worth watching out there. I do think it's interesting that 150.50 has held. Obviously, you know, the one thing I do say in that report is that inflation, bit of a sideshow. The minutes really are the key thing. And looking at the minutes tomorrow, there's a few things that we need to look at that we'll be watching from the sidelines over here. And that will be whether or not Carney voted for more QE. Remember, it was his first meeting as governor. Whether or not others joined him, and we assume no more than 4 people would have voted for it, because obviously it wasn't voted in. Now, if he doesn't vote for QE, then I think there's a good chance that we could see the pound go higher and maybe get above this 152 level. But if we do get above here, there is quite a lot of resistance in the way. There's this kind of like plait of moving average resistance here. The 100 and the 50 and the 100-day moving average at 152.63 to 152.95. And that could really kind of thwart any upside, certainly in the short term anyway. Obviously above there you get to the 154 level, which was the high from kind of mid to late June. A bit of a sticky zone as well. So we certainly don't think we're necessarily going to get too far above there. But in terms of the, you know, where we've been trading over the last kind of 3 weeks, we're trading it towards the top of our range, even though we backed off from that 152 level. But essentially we're in consolidation, and we don't think that's necessarily going to change. Particularly not at this time as we lead up to these all important minutes. Now, one thing I would say about this candlestick here, the last candlestick that we've seen, the market does seem to be putting in, like, you know, their typical consolidation mode candle patterns. Really not making a low. Look, there's a lot of buyers. When you get a very kind of short lower wick, it suggests there's a lot of buyers coming in. They're not trying to push the market any lower, so they're not trying to push us below this 150 level. They may have tested it there on the 15th, which was yesterday, sorry, but we stayed above 150, and that's significant. It suggests that there's no appetite right now to sell the pound below 150, and instead buyers are actually looking to pick it up, possibly because of the minutes, possibly because we've got some risk coming out of the US as well. We have Bernanke, so chairman of the Federal Reserve, is going to be testifying to Congress next on Wednesday and on Thursday. It's on the economy. It's like a semi-annual testimony. The last time he testified to Congress was back in May, and that really caused quite a lot of volatility on the market. So obviously all central bank communication is important. Obviously we kind of get the feeling that, you know, they are fairly dovish. They are probably going to taper, but be quite careful about it. We don't think his message is going to change dramatically, but obviously, you know, he is speaking. If he does go off course quite a lot, then we could see some volatility. But if not, if he sticks to the course he's with, then I don't really see how or why we would break out of this range too much, and it may then come back down to the UK's fundamentals. We do have retail sales on Friday. That could make the UK or the pound kind of the star of this FX world at the moment. Certainly in the short term anyway. Now I also just want to show you Euro Sterling. Euro Sterling's been a bit of a mover today. It has pushed higher, and that comes on the back of some Eurozone data. We got CPI data, which was smack bang in line, but we also got the German ZEW survey, which is very important. So the German ZEW survey was a bit of a mixed bag, really. The current conditions were stronger than expected, but the economic sentiments of the future one actually moderated a bit. So interestingly enough, the market's just concentrating on the current situation, and that's helped push Euro Sterling higher. I suppose as well, having that slightly tiny tad weaker than expected inflation may have kind of scaled out may have just kind of weighed on the pound a little bit. Could have kind of pushed a little bit more onto more expectations about QE. Now Ray can't seem to hear. Ray holds. I'll just ask him to check. Great. So hopefully Ray Halls can sort that out, and it's good that everybody else can hear. Great. Okay, so this is Euro Sterling. As you can see, you know, it's been pushing higher. Obviously, you know, it's very clear now what level you know is the next resistance level, and it's going to be that kind of just below this 88 zone here. That is the high back from March, early March. So we are, we do think that's a significant level. That's the highs of the year. And it's comes at an interesting time because obviously there are signs that sovereign concerns are brewing again. We've got concerns in Portugal. We've got some concerns in Spain both on the political front. But we know how quickly political woes can turn into financial market volatility when it comes down to the Eurozone. So, while Spain and Portugal, they may be contained for now, bond yields also, they haven't really been rising, don't necessarily to take that for granted. And, we do think that euro sterling probably won't be able to extend on gains above 88 on the back of that. Now, as you can see, where could we go? Well, there's some nice support, above 86. I wouldn't necessarily say that we'll fall off a cliff. But if, for example, we get maybe a slightly more hawkish tone to the minutes coming out of the UK tomorrow, then I could imagine a situation whereby euro sterling makes a bit of a reversal. So quite a nice move higher. I mean, that is a really pretty uptrend there. Nice series of higher highs. And we are currently testing the 88 to 70 level or above it, which is important, could get us back to 88. But overall, back to kind of 87, 80. It is obviously an important level, but whether or not we get back there or not, I think it will be to me it seems unlikely, and I think it will be very dependent on the UK. The minutes firstly, and then some other economic data that's out later this week. Now, obviously, as I said, let's look at euro quickly. Because obviously euro is going to be, it's going to be very important, on the back of, this testimony that Bernanke is giving on Wednesday. As you can see right now, it's really caught in a web of moving averages. 130.30 to 130.70 is a really sticky level and has, absolutely support consolidation mode. As you can see, even the moving averages, they flattened significantly, and that also suggests kind of sideways movement. Market's not really been able to make up its mind. Economic data hasn't been terrible. The sovereign crisis, they've been able to, or the problems in Portugal and Spain, they've really been able to brush those off a little bit, and so we haven't really been able to see too much. We haven't really seen too much kind of downside, right, or movements in one way or the other. So we're in directionless market. It's one thing that we would say. Really nice reversal pattern here at that 128 level. And if Bernanke stays as dovish stays dovish and doesn't deviate too much from the message that he gave last week, then we could see us maybe meandering back, but really 132. I mean, obviously, we never want to say markets are boring because they're not. They could change at the flip of a hat, of a turn of a flip of a coin, very, very quickly. But one thing we would say is that 132 is, it does look right now like a significant high. As you can see, the candlestick from the end of last week, a nice upper shadow, very, very long upper shadow. And that's always a bit of a warning sign that the minute we got into 132, that came on Wednesday night after those FOMC minutes, there was like a tsunami of selling. So, right now we do seem to be range bound. This would figure, July, August, they are quiet markets. And we could find that we're range bound just for a few more weeks. Obviously, the key release that everyone's looking at is going to be that September, FOMC meeting when the bank is expected to or when the Federal Reserve is expected to start tapering. Pan, as just said, sorry, can I explain the basic relationship between currencies and CPI? CPI is interesting because, I'll leave the euro for one moment. CPI has a loose relationship with currencies, not a big one. Where it has a relationship is because of bond yields. Inflation can move bond markets, move bond yields, move rate expectations. For example, if you have kind of slightly weaker inflation than expected, maybe that increases the chance of more QE coming from the Bank of England, and that could kind of weigh on a currency and weigh on yields, keep yields fairly low. I'm just going to create a chart pan just to show rather than tell what this means. It won't take very long, guys. I'm just doing it now. It'll take another 3 or 4 seconds. Okay, this is a very basic relationship. And as I said, the one thing I would say is that, inflation and currencies, they don't have a direct link necessarily. It's not like kind of payrolls and dollar yen or anything. It's much more of a second tier type of relationship, but it does have some significance. This chart is, the white line is cable, so sterling versus the US dollar, and the red line is UK gilt yield. So what we've got here, as you can see, gilt yields in the pound actually moved in the complete opposite direction earlier over the past, like about 6 or 7 weeks ago. But then what we saw was the pound actually start to rise on the back of kind of a pickup in bond yields back to kind of that 2.5%. And then since they've fallen 20 basis points, we've also seen the pound fall as well. So just looking at this very, very right-hand side of this chart, then you see the relationship. But as you can see, it's not always perfect. I wouldn't necessarily trade always off the back of, certainly not on a medium to slightly longer term view on the back of inflation data alone. I don't think that would be, I don't think many people would say that would be a good idea. So that's just kind of the basic idea, but it's one of the key things that feeds into a currency's outlook for sure. Okay, so this is euro, as you can see, consolidation. Where we've seen a lot of volatility today was actually in the Aussie. We got some RBA minutes, and they were just less dovish than expected. So as you can see here, we actually had a bit of a nice reversal. It looks like 90. We did touch just below 90. We got to 89.99 on the 12th, so on Friday. But we bounced nicely from there, and that looks like a very nice reversal pattern. Now, as you can see, where can we necessarily go? Now, I wouldn't necessarily say we're gonna shoot higher. As you can see, there isn't too much in the way of key resistance levels just right behind us or right in front of us, but there are what we can do is look at kind of past levels. You still don't understand it, then don't worry about it too much. It's really not a key thing. Just try and go with price then, in which case. So as you can see, so I'm going to go back to Aussie now if you don't mind. Okay, so this is this, as you can see, this consolidation zone, that is a nice bullish harami pattern here. So you get the long blue negative candle followed by a shorter positive candle that's within inside the body of the negative candle. That suggests that candle is a reversal pattern candle, suggests that we've made a low. We've made a low for now anyway. From a technical basis, there aren't any more, there aren't enough sellers to push us below this 90 level. Not yet anyway. That doesn't necessarily mean that they won't be going forward. But where could we go? Well, as you can see, just above this 92 level, we're running into a little bit of congestion here at 92. 92 kind of 20 to 30 is a key level, and then you get above here and it's kind of, 90 gets to kind of 93.15, which were the highs from kind of the end of June. So they're two resistance levels that just could thwart the bulls. As I said, certainly in the next 24 hours anyway, I don't see too much directional movement coming out of the Aussie. And I think, going forward, I think the important thing is going to be, the two important things for the Aussie in the next week. Number one is going to be the testimony from Bernanke tomorrow. If he is dovish or he does surprise the markets, then we could see a big movement in the dollar either way. And number two is going to be the inflation report from Australia next week. In fact, the Minute's actually said that they're kind of, they're going to be waiting on inflation, and that's going to be the key driver of where rates go next. So we could just be in consolidation mode, but it does look like this candle pattern is kind of reinforcing that, or acting as evidence for this view that 90 could be a meaningful low in the Aussie dollar. Okay. Do they expect lower rates? Yes, there is an expectation of lower rates. Some people expect them to cut rates in August, but our view is that they won't, they will not make up their mind until next week when the inflation report is released. They don't pre-commit to keeping rates loose. And in fact, if anything, in the minutes, they said that the rate cut from May was still feeding through into the economy, and also that some of the concerns about the peak in the investment boom and the mining boom were maybe a little bit misplaced for now. Okay, I also want to show you CAD, because tomorrow is a big meeting for the dollar CAD. As you can see, take a quick look at this chart here. It's had quite a nice, no, that's not what I want. As you can see, this is dollar CAD. It had reached as high as 106. It's had a nice pullback. So a nice period of, nice kind of bit of a reversal there. Nice period of kind of, a bit of a correction. Could it move higher? We think there's a good chance it could. We have tomorrow 3 o'clock London time, 10 a.m. US time. We get the latest decision from the Bank of Canada. Really, really important decision because this is the first time under the new governor, and what we've seen from the Fed, from Draghi, from Carney at the Bank of England. When new governors come in, they really like to stamp their authority and they like to do things. And there is expectations that he is very dovish, the new governor at the Bank of Canada, and that he will remove their hiking bias, so their tightening bias from the statement. So all eyes are going to be on that at 3 o'clock tomorrow. And if we do see them remove that, combined with maybe a muted reaction to the Draghi speak, then we could see us get back to the target now is this 106 level. Obviously, there's some very good support around about that resistance. Now about that 104.50 that had been prior resistance, and we could go up kind of just in increments. But I think it's going to be dependent. When you've got those two potentially powerful things, with one central bank moving one way and one moving the other, then and a more dovish tone to the Bank of Canada, then you could see the Canadian dollar come under pressure. Okay, everyone, we've got about 5 minutes left. I'm happy to take some questions, but firstly, I just want to quickly run through dollar yen, because that's going to be really important for tomorrow, for that Bernanke testimony. As you can see, dollar yen, complete consolidation mode. It's currently testing the 50-day moving average, which comes in at 99.55. Haven't really been able to hold on to gains above 100 in the very short term, but as you can see, we haven't really gone anywhere fast. In the more longer term, there's very good support kind of around about that 98.80 level. And then here, the 97.97, which is the 100-day moving average. But right now, we're still managing to cling on to that 99.50 level, which is the 50-day moving average. And I could imagine us kind of really range trading. Obviously, we have got some data out of the US later today. CPI, we've also got some Treasury purchase data, and we also have some industrial production data. The Treasury purchase data is going to be important because obviously yields have been rising in the US in recent weeks. Are people still attracted to holding treasuries? So we could see a little bit of volatility, but overall we could see us kind of trading between 99.05 to 105 really, in a 100-pip range over the next 24 hours. As we wait for 24, 36 hours, as we wait for Bernanke and what he has to say about the economy. Obviously, if he maintains the kind of slightly dovish tone that we saw last week, then we could just drift lower to this kind of 98 zone here where that key support level is. But overall, as you can see, completely in consolidation mode. Nothing at the moment to drive us one way or the other, but do watch out for that data later on today. Okay, everyone, is there anything else you'd like me to go through? I'm happy to take a question or two. It's kind of about it from me. We've gone through quite a lot of things. There's a lot of, for me, when we've got really important, data or really important like central bank data out like that, it's good to stick with the majors because they can sometimes move. Pan, my view on QE, please. We stick to our view that they're going to taper in September. Tapering will be quite small. What we think they're going to be saying in a very clear way is what they're going to be saying in a very clear way, though, is what we expect. Is that we expect him to say, yes, even though we'll taper, we'll be quite relaxed about tapering. But what we will do is keep interest rates low. And we could be in a very strange situation. Now, this might get a bit macro for some of you, whereby the Federal Reserve actually reduced down their growth expectations. However, they also, taper in September. Now, this is quite important because GDP is not fantastic, even though the labour market's doing well. That's going to be a key thing that we're going to be looking at for in this testimony tomorrow. How he feels about that, about testimony not do about the overall GDP not doing well, but the labour market doing well. So certainly worth looking out for. Oh yeah. Can I explain the use of moving averages? Yeah, moving averages are, these are just simple moving averages, 50, 100, 200. What they're good for is smoothing out price action. So you see kind of the direction rather than actual price action. And what they're really useful for is, the reason why I use 50, 100 and 200 is that they're the most popular in the market. And when you're looking at technical analysis, you always want to look at what other people are doing. So you don't want to just be looking at something unique to you because the price might not move there. 50, 100 and 200, they're significant levels and can act as significant support and resistance levels, and they can hold. So this 50-day moving average is important. So all they do is they just literally, they smooth out price action because obviously they're an average price rather than, all this kind of, jolty noise that we see on this candlestick chart, and they can be used to support resistance. That's the key thing. Okay, if any questions, run quickly down. Otherwise, I will let you go. Gold, yeah, gold is quite interesting. This will be my last one, guys. Take a quick look at gold. It's had quite a nice recovery. But again, getting thwarted at that 1300 level. Whether or not we get above there will be very dependent on what the Fed says. Obviously, if the Fed sounds quite dovish, like there's going to be QE, then we could get above here. 50-day moving average now key resistance 1344. Obviously, if he sounds a bit more hawkish than expected, then we could revert. Then we could kind of see a bit of some downward pressure on the gold price. And 1263, then 1220, massive support levels. But we are, at the moment we are very much range bound, and I expect us to be range bound for the next 24 hours at least until we hear from Bernanke. 1300 capping upside, give it 1310 if you're in a trade, and 1200. Okay, everybody, let's go. This is the end of the webinar, and thank you for joining. Please do join us next time. Bye bye.